In this lesson, you're going to learn how to calculate valuation multiples for each company in our set of public company comparables. Now, to recap from last time, what we had done was we went through and filled out the operating statistics for these companies: revenue, EBITDA, EPS, equity value, enterprise value, and we looked at some of the metrics around that, like revenue growth, EBITDA margin, and so on. And then you had some practice filling in the same information for Apple, the company that we're analyzing here. What we want to do next is actually look at the valuation multiples here. Because remember that back when we went over equity value, enterprise value, and multiples, we said that the point of multiples is that you need to normalize companies. Because if a company has a completely different revenue or a completely different EBITDA from another company, it could just be that it's bigger. That doesn't necessarily mean that it's more valuable. So just because it has 10 times the profit, the relevant question is not what their profit is or what their revenue is. The relevant question is, how does the market value them based on their revenue or based on their profit? In other words, what is their valuation as a multiple of that revenue, profit, free cash flow, earnings per share, or anything else here? So I'm going to show you exactly how to calculate this for the first company listed here, Hewlett-Packard. And then once I finish with that, you'll get some practice calculating it on your own for the rest of the companies in this set. So for Hewlett-Packard, the first one here, enterprise value to revenue. So what we want to do here is take enterprise value and then just divide that by Hewlett-Packard's revenue up here at the top. So we have a revenue multiple of 1.1x for them. And we could do the same thing for 2010. We could just take enterprise value, go over here, and then go up to the top and divide by the 2010 number. We could do that, but that is fairly tedious. It would be much faster if we could actually just take this number and copy it across. So let's try to do that. I'm going to press copy, Control C, and then Alt ESF. Okay, and now we see we have a problem because our multiple here has gone to 0.0x. The problem here is that we have also copied across the first part of this formula. So instead of being linked to enterprise value now, it's being linked to 2009 revenue multiple. So instead of the L25 here, we want it to remain at the K25 that has the enterprise value. So to fix that, we're going to do something called anchoring a cell. To anchor a cell, you press F4. When you have two dollar signs, as is the case right here, that means that it will never shift around column-wise or row-wise whenever you're copying it anywhere. So if we copy this formula elsewhere, it's always going to remain in that exact same cell. If we press F4 again, then that means that the 25 part, the row, will never shift around. What we actually want to do here is make sure that the column never shifts around. So I'm going to press F4 again, and now the dollar sign here is in front of the K, which means that the column is going to stay constant. So with that in place, I'm just going to take this formula, copy it across with Alt ESF. The reason, by the way, that I'm keeping just the column constant is because later on we want to be able to copy this formula down, and to do that we don't want to have to bother with redoing the formula for every single row. We want to just be able to copy this formula down as is, and for that to happen the row needs to be able to shift so that we can move from Hewlett-Packard here to Dell below it. So that gives us all the multiples for the ones here at the top. For the PE multiple, remember that for PE we take our share price right here, which I will anchor with F4 pressed twice, and then we divide by earnings per share. So this is not an enterprise value based multiple, this is an equity value or share price based multiple. Take that and copy it across. And so that's the basic process for how you calculate all of these valuation multiples. What I want you to do now is to make the calculations for Dell. Don't just copy the formulas that I have up here. Actually go in and calculate everything out using enterprise value and share price for your numerators, and then revenue, EBITDA, and EPS for your denominators. Go in and make the calculations, and then if you want, you can also fill it out for the rest of these companies right here, and then also for Apple here at the bottom. So pause this video right now, and using the F4 key along with Control C and Alt ESF to copy and paste formulas, go and give this a shot yourself. Once you're done, you can unpause the video and then I'll walk you through it and show you exactly how to do this. Okay, good. So here's what we do for Dell. So we're going to take enterprise value. I'm going to press F4 once, twice, 3 times to anchor the column part K right here. Then I'm going to divide by Dell's revenue above. I can actually just copy this formula across, Control C and Alt ESF. And then for the PE multiple, I'm going to take their share price. I'll hit F4 3 times to make sure that the C part does not shift around. And then we'll divide by their earnings per share at the top. Take that and just paste that formula. So we have all that in place. The next step here is to just highlight this whole thing with Shift Control right arrow key, Control C, then Alt ESF to paste all these formulas. And so now we see that everything here is in place. One problem is that we have a negative PE multiple here for Motorola because they had a negative EPS. To fix that, we can actually just do a simple check here in the beginning of every formula, and we can just say that if this is greater than 0, then we can display it. Otherwise, we can display NM. NM stands for not meaningful. So that's a quick, simple fix to this formula. I'm just going to paste it around for the revenue and EBITDA multiples, and then for PE, do the same thing. So again, just checking to make sure that these multiples are all above 0. We see that here, sure enough, this goes to NM, indicating not meaningful now. We can also now paste this formula down for Apple. And so we have all of their valuation multiples as well. The last step in this, now that we've actually calculated all these, is to look at the data overall in the set. So the 75th median, 25th percentile, minimum, maximum, and see what it can tell us and how Apple stacks up next to its peer companies, its comparable companies. So for this one, we can actually just copy this formula from above where we use this same setup. Now we see that we're properly calculating it based on this data set instead. So I'll take this and copy it across. Okay, and so now what we want to do is compare Apple to the median of the set and also to the high end of the range because that's what it's closest to, and see what it can tell us about its valuation. So as expected, Apple is valued significantly higher than the median of the set of comparable companies. If you look at revenue multiples, they're valued at about 3 times the median. EBITDA multiples are not quite as high. They're about 50% higher than the median of the set here. If you look, Apple's revenue growth exceeds the highest number in the set, so it's not surprising. Their EBITDA margin is also on the high side, so that explains why the EBITDA multiple is higher in this example. They have a higher revenue growth as well as higher margins, which means that you would expect the market to value them more highly than the rest of these companies. Now, the PE multiple, they're much closer, and it's really hard to say anything definitive here. The problem with PE multiples, especially in this case, is that you have things like tax expense, interest income getting in the way and interfering with what's in there. So it's hard to say anything too conclusive about this. One thing that is interesting, though, is that they are still below the maximum of the set here. We see that that's Intel and Motorola for 2009 and 2010. So on a PE multiple basis, Apple is actually valued much closer to the median of the set of comparable companies here. It's not clear exactly why, but one reason could be that when we take into account depreciation, amortization, interest expense, and everything else like that, then Apple looks far more similar to its comparable companies, and perhaps that's why on a PE multiple basis, the implied multiples here are much closer. So that's what we can say based on the set of valuation multiples here calculated for the comparable companies and then looking at Apple's own valuation multiples. Coming up next, we're going to be going through and looking at our set of precedent transactions and figuring out how to get the data, how to narrow down our set, and then looking at the metrics and multiples once again to see what it can actually tell us about Apple's valuation and what proper multiples for this set of companies, similar companies, might look like. After that, we'll be getting into the DCF analysis, and then we'll be tying together everything in the end by looking at all the valuation methodologies displayed right here. We'll look at the ranges of multiples and come to some conclusions about what Apple is valued at, what its value should be, and what an appropriate per share price for the company might be.